This episode is awesome. I spoke with Mike Roeder. I've known Mike for a couple years now, a few years. Mike lives in Minnesota, but he's bought several deals here in Nashville. And what's really cool is I've toured a lot of those properties, probably around the same time that they were touring them. And he and his team had the best offer, put the best offer in and won those deals. So it was cool to kind of talk to him about some of those properties. Mike's just such a great guy. He was one of the very, very first people I knew that was doing multifamily syndication. And he is just, man, he has not stopped. And since the time I've met him, he's only ramped up. And they have a really awesome process of how they find deals and what they look for. And Mike goes over that. We talk about that for a few minutes. So a lot of really good nuggets in here. Mike was in insurance sales for about 10 years or so. Went the single family route like most of us do, and he quickly found out that it wasn't passive, and so around that time he met his now partner that was investing in apartments, and so that he was able to scale much more quickly, but also didn't have to go and handle the day-to-day because property management companies are there, and so they rely on, not only are they getting better returns, but it's less work for them because they have maintenance and on staff employees. So anyway, great episode with Mike Roeder. Thanks for checking it out. Welcome to Passive Investors Playbook. I'm your host, Charlie Hardage. In each episode, we'll sit down with successful people that turn to real estate to build and grow their wealth. We do a deep dive into why they chose real estate and what makes it so attractive to them. We explore why people in their industry could also benefit from passively investing in real estate. Whether you're a beginner or an experienced investor, a doctor or a professional athlete, love your job or hate your job, our show is here to help you build a profitable real estate portfolio while maximizing your free time and minimizing stress. So sit back, relax, and get ready to learn from some of the best in the business. Welcome to Passive Investors Playbook. All right, thank you for tuning in today. My name is Charlie Hardage, and I really appreciate you listening to the Passive Investors Playbook. I have a really special guest today. His name is Mike Roeder. Mike was a top performing high net worth insurance producer for a Fortune 500 company for over a decade. He had been investing in single family investments, but transitioned to multifamily in 2015. Today, he is a general partner in over 2,500 units, valued at over $370 million in assets. That's amazing. Mike is the co-founder of Granite Towers Equity Group, a real estate private equity firm. Mike and his business partner, Dan, focus on acquiring and managing multifamily projects across the nation. Mike is also the co-host of the Keeping It Real Estate show and co-author of the book, 4 Steps to Successful Passive Investing. Mike lives around the Twin Cities in Minnesota with his wife and children. Mike, I'm so excited to have you on my show. We've known each other for a couple years, and as I mentioned pre-call, you're one of the first real people I met in multifamily syndication a few years ago. So thank you so much for being on the show. I'm really excited to talk to you over the next 45 minutes or so.
Well, thanks so much for having me on, Charlie. Really excited to be here today.
Awesome. Makes 2 of us. Mike, can you tell the audience a little bit more about yourself and about your background?
Yeah, most definitely. So like you had mentioned, I had a corporate career for about 10 years as an insurance producer, started out selling personal lines insurance, so auto insurance, home insurance, and whatnot, and then shifted into the high net worth space after a few years of being in the industry. And how I got my foot in the door with real estate is I actually house hacked my first house when I was about 20 years old is when we bought that first house. So it was myself, my girlfriend, she's now been my wife for about 14 years. And we bought a 4-bedroom house close to campus. We were going to college. And we rented out 3 of the bedrooms, lived in the 4th bedroom, fell in love with the cash flow, and it was a great time. We had our buddies living with us. So
That's awesome.
it was just a great avenue to get into the real estate game. We eventually turned that into a rental property, bought a couple more single family rental properties. And at that time, I put a goal into place. I wanted 100 single family rental properties eventually. I didn't have a timeline around it, but that was my goal. And, I took a step back and said, hey, what is it going to take to be financially free, to have a great amount of passive income coming in so I can retire and do what I'd like with my time? Well, after accumulating 3 single family rental properties, I was doing all the property management. So I was doing all the maintenance. I was leasing the units. I was evicting tenants. Every single aspect that goes into managing a property, I was doing, so that way those properties could cash flow. And so what happened is I started to experience some burnout. I was driving an hour to my corporate job, and then I would drive home, and then I would drive another hour to where my rental properties were, a few days a week, and do the maintenance and do the leasing and do the evictions. And it just wasn't worth my time. But I knew that real estate was the avenue that I wanted to take to become financially free and to build my passive income. So at that time, I started getting educated. I read a lot of books. I talked to a lot of other investors. And actually, my business partner that I've been doing business with for about 7 years now, he was buying apartment complexes, and he was at the exact end of the other spectrum. So he had third-party management in place for those assets. He had a 24 unit, a 20 unit, a 9-plex, a duplex. And so he wasn't doing the day-to-day operations. So they were cash flowing. He was able to mitigate his stress. And so I figured out that apartments was the route that I wanted to take. So we ended up teaming up together, bought a 20 unit together, bought an 8 unit together. Those deals did tremendously well when we purchased them. And so we decided to go into business, form Granite Towers Equity Group about 7 years ago. And we started to syndicate projects. So raise capital from passive investors to buy bigger, better properties in better markets.
Man, that's crazy. So you were, I think you said 20 years old. You and your now wife bought a house together and were house hacking. And so that's basically, that was your primary rental or your primary residence. But then you had extra bedrooms that you rented out. And so those 3 rooms you rented out, you're probably paying almost nothing to live there, maybe even cash flowing a little bit, which is what house hacking is. And so then your goal was, hey, this is great. Let's get 100 single family homes. You got to the huge number of 3 before you're like, oh, I'm about to burn out. I got a family, got a job, and you're doing it all yourself. And I think that's what a lot of syndicators do. That's how they start. That's how a lot of the audience probably is thinking about starting as well. I've been a landlord a few times, and it's a few too many. I did not like it. It was, little things that maybe were broken or could be fixed. I'd go to the property, wouldn't have my tools because they didn't tell me about it until I got there. And so fortunately, we never had any major issues. Hopefully you didn't either, but it was always just this kind of time suck. And it went from what I thought would be passive to no, not really. And that was only so it would cash flow, right? Because if you had to pay in 10% to someone, a property management company, you're probably not cash flowing much at all.
That's exactly.
Yeah.
Exactly. And on the property management side, there's a huge difference in between single family and multifamily.
Yeah.
First off, a lot of times, a lot of the great management companies, that have great personnel, they don't want to get into the single family because it is such a hassle. Plus, like you said, it's a lot higher management fee, a lot of times 10 to 15%, whereas, the larger multifamily, you're paying 3%. So there's a lot of benefits with multifamily.
Oh yeah. And can't wait to dive into that as well, because I'm huge on multifamily as well. So you got up to 3 homes. You met Dan. And you saw, how's he buying these? He has more units than you do, and he probably had a lot more time because he wasn't doing the day-to-day. He had property management companies that were doing the day-to-day, week to week, and where he was kind of managing the manager. So then at that point, you guys got into, I think you said, a 20 unit and an 8 unit. Is that correct?
Correct.
And I'm sure at that point you're like, wow, I've been missing this for so long, and you knew real estate was great. And to start, you got with single family, because that's what most people do. But then when you saw that Dan was doing it a different way and a better way, you said, yeah, let's do that. So I love that story. Let me ask you this, Mike, how, like, I know you said that real estate was a path that you wanted, and you thought it was single family. You found out it wasn't necessarily single family, but even before that, why do you think real estate is just such a great way to build wealth?
Yeah, there's a few different reasons. So first off, you have cash flow, so you're able to build up passive income if you buy the right real estate, right? Otherwise, it's more like active income because you're working for it.
Right.
So you got to buy the right real estate. But I love the appreciation aspect of real estate, and especially the forced appreciation aspect. And there's a big difference in between, single family and larger multifamily. Because single family, your value is really based off of the competitive market. So
Yeah.
What is the neighbor selling for? Well, that's probably what you're going to get if they're a similar, build property, similar size. Whereas multifamily, let's say we buy a 100-unit property, the value on that asset is based on the NOI. So the net operating income, the income minus the expenses. So if you can drive the income up or drive the expenses down, you can impact the value of that property significantly. So you have forced appreciation, you have a ton of tax benefits, with the larger multifamily, which I love. You're able to spread the risk out amongst many units.
Yeah.
So you're mitigating risk. If you think about a single family, like we had a single family rental, one of the 3 that we owned, and we had to replace the HVAC system, and it cost $6,000, and that ate up our cash flow for a couple of years.
Yeah.
Whereas on a multifamily asset, if that happens to a unit, no big deal, because you can spread it over a bunch of units. So that helps significantly as well.
Yeah. I totally agree with that. And I love what you said, especially, you're in insurance, but risk mitigation, risk mitigation and spreading the risk between not one unit, but 100 units, right? And what's nice about that, and you and your partner, when you guys underwrite, you're not underwriting at 100% occupancy the whole time. It's probably 95, 96, 97, depending on the market. And you are 100% accounting for vacancies, which is just, you can't really do that. I mean, I guess you can in single family, but if someone's not there, how long are you not getting rent? It could be 2, 3, 4 weeks, and hopefully you have enough in reserves to cover the mortgage for that month and the turns, like whatever you have to do to paint or carpet or whatever. So I love those benefits, Mike. You mentioned cash flow, appreciation, and forced appreciation, and we talk a lot about the forced appreciation, and also called value add. And I love what you said. With commercial property, it's valued based off one of the components is NOI, or net operating income. So that's all of the income minus operating expenses. And so if you and your team can run a property more efficiently than the previous owner, even if you don't raise rent or income or anything like that, you still have a more valuable asset. And I think that's so overlooked that, you don't get that with single family, right? If you go from a property manager that's 12% to 10%, property is not worth anymore. But it is in multifamily. So I love that. Obviously, huge, tremendous tax benefits as well. So there's just so many. One of my biggest things in real estate in general is the leverage. Financial institutions know that it's a very, very safe investment, and so you may only put 20 to 30% down on a property, but you're able to capture all of the appreciation, right? You don't have to share that with the bank.
Yeah, the lending is very advantageous. Another aspect is, you have recourse loans for your single family properties. So you're on the hook, your personal assets, whereas a larger multifamily, obviously you never want to lose a property. We never intend on that happening, but it's non-recourse debt. So they're not coming back against your personal assets. Plus you have, longer interest only, which means, that's going to boost your cash flow because you're just paying interest and you're not paying down the mortgage for that first few years while you get through your business plan. And I mean, there's a lot of different benefits with the multifamily lending.
Yeah, definitely. And I think we could talk about this for a long, long time, just all the different benefits. So Mike, you were in insurance, and I didn't write everything down, but you said you're doing something like home, car, different lines like that, and then you did kind of move to the high net worth I guess life insurance. I don't know if I caught that, but more of the high net worth. You did that for a total of about 10 years. Why did you say, hey, I'm leaving this and I'm doing real estate? Like what was it that made it so attractive to you?
Yeah, I was very fortunate. So the last, 4 or 5 years of my career, I had pretty much complete flexibility with my time while I worked my position. Otherwise, I would have been done much earlier. And when I was doing high net worth insurance sales, I was still selling auto, home,
Okay.
umbrellas to high net worth clients across the nation. But it was a sales job. So as long as I hit my numbers, I could spend the rest of my time on real estate. So really about 5 years back, I went from, probably 50 hours a week down to 30, and then I dropped it to 20. And then the last couple of years, I was probably working 10 hours a week, still hitting my numbers, but being able to, allocate most of my time to our multifamily business. And then about 2 years ago, it just became a distraction. And all I wanted to do was focus on our multifamily business. And, it was just unenjoyable to be doing the insurance gig when all I was thinking about was multifamily. So about 2 years ago, I hung it up with the insurance gig and just went full-time multifamily investor.
That's awesome. Do you have any regrets?
No, not at all. I actually talked to a gentleman I used to work with a few weeks ago, and he's like, "Hey, my boss is asking, what would it take for you to come back? They wouldn't do any meetings, they wouldn't check in with you. You just have to, sell insurance." I'm like, there's no way. I am, so happy what I'm doing now. So
that's awesome. Yeah, what's really cool, I think, too, about the syndication space is, we're not just buying a one house, right? Where you can't really change the neighborhood or can't really control the community. But in an apartment complex, you actually can impact, and maybe it sounds corny, but you really can impact lives, right? You can create more of a community space, whether a safe space, whether that's putting a gate up or security cameras, adding a park, or really just being able to provide more of a family-friendly environment. I know I've toured some of the properties that you guys own only because they're in Nashville, which about 20 minutes, 30 minutes from me. And I know you guys have done that with some of those properties, just more of like a safe space. So at least, and I'm sure you and Dan feel this as well, but it is kind of nice, get some pride of, we're not just going in there raising rents. We're actually providing value to friend, like we would to friends and family, right? We take care of them. Kids aren't tripping over flooring or anything like that, and it's just more of a safer space. So I'm sure because you have two children as well. I have one, but I think at least from the father perspective, it definitely feels nice. In addition to having your time, right? Your time back. You can do whatever you want, but
yeah, I mean, the amount of fulfillment that you get from that
Yeah.
is pretty substantial. And like you said, I mean, a lot of these families, that's their home. That's
Yes.
where they live. That's where they're raising their children. I think about an asset that we're purchasing right now. We're in the midst of it, and the pools are green. So there's two pools. They're green. Ton of deferred maintenance. All the amenities are pretty much shut down, and we're going to be able to come into this project, stick about $2 million into the rehab projects, get the pools up and running. We're going to install either a playground or a soccer field for the kids, make the asset just look really nice.
Yeah.
And, like you said, I mean, you do bump the rents a bit, to create the value, but you're just going up to market like the competitor properties are, but you're providing such a better home for these tenants to live at. And then we always focus on community too. So we're doing community events, whenever, a holiday pops up. So, Easter, Christmas, back to school, we're doing community events at the apartment and trying to give some back to the community and also create a community feel, have the neighbors meet their neighbors and spend some time with them. So it's just very fulfilling being able to transform these properties after you get in and you implement your business plan.
Yeah. I was actually trying to find that word, couldn't figure it out, but you said it, fulfillment. I think there's a lot of fulfillment in doing what we do, and not even just for the residents that live there, but for the office staff, because they have more pride as well. Our investors, and you've I forget how many units it was, 2,500 units or so, but you've done it on a much bigger scale than I have. But I think even the passive investors, they get fulfillment of that because you send out pictures, they get the emails, and it's just like, I'm doing that as well, right? And so I think there's just it's a win-win-win for everyone, I think. And again, could talk about that for a long time too, but not going to. So I do have a question about I had some audience feedback of, hey, this is great, but maybe I don't have that cash, right? Maybe I don't have the minimum amount to get in. Do you mind maybe sharing a story of how you got into a deal? Maybe it was cash, maybe it wasn't cash, but just like ways that people can get into a deal and maybe they don't have the cash?
Yeah, definitely. So, going back to my start, I utilized pretty much every avenue for gaining the capital to be able to buy those single family residences or rental properties. So a few avenues that we took, we did a home equity line of credit. That was actually to purchase our first 20 unit property. So we had some cash built up, plus we did the home equity line of credit. I did a 401k loan, was able to lend money from my own, 401k and pay interest back to myself. That worked phenomenal. Personal loan from a relative, we did that. And then also, there's IRA, self-directed IRA companies now, which I did not know back in the day, but that would have been a fantastic avenue as well. Because if you have an IRA or even an old 401k from a previous employer, you can convert that to a self-directed IRA with a company that allows that, and you can invest that passively into a real estate offering. So that's just a great way to get your foot in the door, be able to see what, these real estate investors are doing, how they're running the project, be able to build your income, going into that IRA as well. And if none of those options are an avenue, just learn, go out there, listen to podcasts like this, read books, get on the database of people like you and I, Charlie, so that way you can see, different syndication opportunities and really just understand how they're putting together these deals and what's all involved in them.
Yeah. I love that. The HELOC strategy, we've used that. I've not actually thought about a 401k loan before. So thank you for bringing that up. I know the self-directed IRA and the solo 401k, like you mentioned, Mike, there's what's called custodians, right? It's not going to be a Fidelity, a Merrill Lynch, Edward Jones, those guys, but there are custodians that will allow you to invest in alternative assets like syndications. Which is a great strategy, and I appreciate you sharing about the personal loan as well. And if you're still kind of on the fence, it doesn't hurt just to learn, right? And sit back and listen to other people and get into those communities, those circles. Mike, I know just from talking to you previously, like you and Dan both, and I think a lot of people in our business are just so happy to talk about it because it's not the norm. And I think a lot of us, myself included, when they hear about the syndication piece, and it's not necessarily, the traditional W-2 IRA 401k path, a lot of people perk up and they're like, wow, I've never heard of that. And so, I encourage the audience, if you have any questions, definitely reach out to Mike. Mike's a great guy and can help you, at least point you in the right direction, give you some good advice. So yeah, thanks, Mike. I appreciate you sharing that. So I know, kind of mentioned this before, but Granite Towers, you guys have deals all over the Southeast. I invested in one of your deals in Birmingham, 3 years ago, I think. I know you guys have several assets around me in Nashville. You have some in Texas. Who knows where else you guys have them. What do you guys look for in a market?
Yeah, that's a great question. And before I answer that question, going back to when I got started, we were very opportunistic. If a deal looked really good on paper and we liked the submarket, we were jumping into it. So like you said, we bought a deal in Alabama. We had a few deals up in Minnesota where I live, so close to home, Western Wisconsin. We bought a deal in New Mexico. And that, in my opinion, that was a mistake. I wish we would have, been really focused on one or two geographic regions so we could really build out our bucket, get the economies of scale, and really understand those markets. So about 5 years ago, we ended up shifting to just Dallas-Fort Worth, and then eventually we added Nashville. So those are our two markets that we're honed in on today.
Okay.
And, what we look for when we get into a new market is a couple different things. Job growth is very, very important because, that's tenants that are coming, or prospective tenants that are coming to the market. We also look for population growth. Those kind of go hand in hand.
Yeah.
We look for landlord friendly states, but not only that, landlord friendly cities, because you can have a city within a landlord friendly state that's not as landlord friendly. And that's just going to create more wins at your sale. It's going to be easier to create success with the project if you have a landlord friendly, city and submarket. Crime is really, really important to us as well, just to have low crime rates around the properties that we're buying. It's also very important for us to get into major MSAs, so markets that have a significant population. And we've dealt with some really small markets, and it's been tough in some of those small markets because it's harder to find contractors. It's harder to find really good property management companies. You always want to have a couple backups too, just in case something goes awry. So it's important for the market to be a little bit bigger. And yeah, a lot of other, important aspects like supply, that's very important as well. But those are some of the major factors that we look at when we're going into a new market.
Awesome. Yeah, I think, those, and obviously you look at the deals as well,
Yep.
and the surrounding areas, but I think that's a, phenomenal starting point for so many reasons, because you're looking for landlord friendly states and cities. You're looking for areas that are growing, and you're looking for safe areas that are growing in large areas where you can get not only residents, but contractors and good property management companies. So I think that's, it sounds easy to say, I think, Mike, but that's actually extremely important. Just what markets you look at, and just because you're looking at Nashville doesn't mean you're going to invest everywhere in Nashville, right? And just like other states, cities and states. But what I like about what you said is it was a mistake. Maybe the Minnesota deals or New Mexico deals or whatever was a mistake. Not because the properties did poorly. I'm sure they did phenomenal. It's just your attention was spread across too many markets and not hyper focused on one or two markets like Nashville and Dallas.
Exactly. I mean, at first it's okay because you're able to fly out to those markets, do the site visits, but once you add a few additional assets, then you're flying all over the country.
Yeah.
Your time is obviously very valuable. Plus you have to keep up to date on the markets, what's happening with the landlord laws, what's happening with the supply, what jobs are coming into town. What are the occupancy rates, looking like? There's so many factors that you have to be really in tune with. So the more spread out you get, the harder it is to really be very knowledgeable with all those aspects.
Well, okay, so I want to transition slightly from the market, right? Let's take Nashville just because I live here, but let's take Nashville, and besides just the market, because we do know that Nashville is growing like crazy, very landlord friendly. State, Tennessee, and then Nashville as the surrounding area is very landlord friendly as well. For the most part, low crime, some spots maybe not so much, but now take me through a deal. What are you looking for in a deal? Because there's properties that come on the market all the time. I know you guys don't go after every single one. What do you look for in a deal? Both from what does the actual property look like, and then investor returns for your passive investors?
Yeah, great question. So when we're looking at a deal, first off, we want to make sure that it's in a good area. So we have some criteria. Household income has to be above 50,000 on the 1 mile radius. If it's not, then it's out of the mix. We also take a look at the neighborhood data. So, there's neighborhood income levels, which are even more honed in than the 1 mile. So that's very important to us. We look at the crime rate. We also take a look at the delinquency on the property. And if there's, very high delinquency, we're probably going to pass on that opportunity because that's, what that property is attracting. Now, as far as what we look for our returns, that adjusts as the market is adjusting. So right now, we're seeing 80 to 90% total returns over 5 years is what we're projecting on our assets. And then cash on cash, we prefer to be in the 5% plus range. And cash on cash, that's basically the cash coming back to you from your investor or from your investment on, a monthly or quarterly or semi-annual basis. So if you stick in $100,000, you could expect about $5,000 a year. And then the remaining return, comes when you refinance or sell the property. Couple other metrics, rent growth is very, very important to us. So we're honing in on what has the historical rent growth been like over the last 10, 15 years, plus what's the projected rent growth going to be like. Over the last few years, rent growth has been very, very high, 10 to 20% in a lot of markets. That's starting to cool down. So we just want to make sure that we're using really conservative numbers. So a lot of times right now we're using, maybe 2.5 to 4% for rent growth, and not the 10 to 20% that we've realized over the last couple of years.
Yeah.
Vacancy rate is really important. There's a lot of other important metrics as well.
Yeah. And you mentioned delinquency. Can you explain that to the audience?
Yeah. So delinquency is, bad debt. So it's the income or the rents that you're charging back to your tenants that they don't pay. So if you have $1,000 a month and a tenant doesn't pay that $1,000 is going to go to your delinquency. Now, just to dive into that a little bit further, you have vacancy and then you have economic vacancy. So your vacancy is basically the unoccupied units at the property. While economic vacancy is actually way more important than vacancy because it factors in bad debt or delinquency, factors in concessions. So if you're needing to give away, maybe some free rent or some other freebies to attract tenants, it's factoring in, any of your on-site employees, if they get free units at the property, it's factoring in that as well. So the economic vacancy is very, very important to tune into.
Yeah, definitely. And thanks for kind of going over your market criteria, your deal criteria, because I really think it helps the audience get a better picture of, what it is that I do, what it is that you do, and how it's done. And, I brought this up before, but one of the properties, and I won't say the name of it, but one of the properties that's actually up for sale now with you guys, when I toured the property, there was deferred maintenance everywhere. I remember some of the cabinet doors were coming off slightly. And remember, this was a property they were showing to people, right? They were selling it. It wasn't just like I happened to walk in there. They were selling it. The pool area was not very homey, right? It was just like, oh, cool, there's a pool with a couple chairs that hasn't been updated in forever. And so, want to kind of paint that picture, Mike, because I think that's really important for the audience to kind of see, and you talked about it too, but you're not just going in there and say, okay, cool, let's raise rents, because guess what? People are going to leave, right? They're not going to stay there. But you're looking for a good tenant base where there's not a lot of bad debt, delinquency, where people are actually paying. But there's this gap of people want more than just a property with pools that are green, right? People want playgrounds, and people want, and I think part of that too, Mike, is, if you do have bigger units, because not all apartment complexes are the same. Sometimes you have properties with bigger units. Those are probably going to have more families, right? And not all properties have 3 bedrooms or 4 bedrooms even. And so if you see something with 3 and 4 bedrooms and there's no playground, that's a huge, easy win right there. Just add a playground and a little picnic or park area. And so really appreciate you walking through the markets you like, what you look for in deals. And then just to recap that, you and Dan and your team look to get about a 5% cash on cash. So again, you invest $100,000. On average, you'll get about $5,000 back each year until the property sells. And then that's when you get your money back plus another, 70, 80%, whatever the numbers are.
Yeah, exactly. And going back to, what we look for in a deal, we're typically buying B and C class multifamily apartments.
Mm-hmm.
So not typically new build or something that's near brand new, because like you said, we're looking to go in there and add value. Typically we're bringing in about $10,000 to $20,000 per unit for rehab, and about half of that goes to the interior units, so flooring, cabinets, countertops, lighting, and then half of it goes to the exterior and amenities, to really spruce up the property and attract, a better tenant base. And like you said, that property that you toured, in Nashville that we bought a few years ago, we're selling it right now at about, the value of the property is increased by about 35 to 40%. That property, I mean, we painted the full property. We did a lot of parking lot repairs, pool repairs. We added a new fitness center. We added a playground. We relocated the office so that way we could add an additional unit. We split a couple 4-bedroom units into 2-bedroom units so we could add, 2 additional units there. Redid the laundry room, and that property is just completely transformed. It's been really fun to watch.
Man, I remember driving in there and the signs looked like they were from the 80s or 90s. I don't remember there being a sign for the office. And so I actually I took a right and did a whole loop. And then I'm like, I don't know where it is because there was no signs. And then the office, there was a sign over the office, but it was not easy to read. So you'd really have to and I put myself in a prospective tenant shoes, right? How would I easily be able to go and find the office? And I wasn't.
Yep.
So I'm sure you guys took care of that. That's, in my opinion, a multifamily 101 rule. Is just make it more accessible and easier to see.
Very important. Yeah, we redid all the signage. The office is very evident where it is. And that's extremely important because if someone can't find your office right away, that's a huge issue. They might go on to the next property. There's lots of competition out there. So your marketing and your signage has to be on point, in person and online. It's crucial.
And that goes back to one of the, value adds. You're not raising rent because you relocated the office. You're just making it nicer looking and easier to access. And in my opinion, tenants are going to like that more because, it's right here. You're not going to lose people because they don't know where the office is. But I know you guys are doing great things on that one. There's a couple other properties you have in the area that I've not driven those. I'm sure you're doing equally as awesome of a job there with those. Mike, I know we have a few minutes left, so I want to ask you about a recent book that you've read or listened to that really stands out, whether it's real estate, self-help, business related.
Yeah, one of my favorite books that I've read recently was Shoe Dog. It's a phenomenal story about the founder of Nike, Phil Knight.
Yeah.
And, just his perseverance, his persistence really resonates with me. And I actually read it to my 11-year-old recently, and she absolutely loved it. And it's a pretty thick book, and there's a lot of business information in there as well. So that's been a lot of fun. Just started on The Power of One More by Ed Milet as well. So excited to get into that one as well. But yeah, for anyone out there, those are a couple really good books.
Awesome. Yeah, I've heard Shoe Dog many, many times. Haven't read that yet, and I'm actually in the middle of The Power of One More right now. Definitely appreciate those recommendations because the Shoe Dog by Phil Knight, he just seems like he's accomplished so much. And I, again, haven't read the book, but he's very, very inspiring. So I'll definitely check that book out. What can people expect to see from Granite Towers over the next 5 years or so?
Yeah, the next 5 years, we're going to continue to do multifamily assets, ranging anywhere from about 100 to 300 units is really our sweet spot in Nashville and DFW. So I would say from here on forward, 3 to 6 or 7 acquisitions per year is what we expect to see down the pipeline. And then we are also exploring the triple net lease space, being very selective in that space, but we expect to do, 2 to 3 of those per year as well. And, from there, just building out our team. Right now, we have an in-house team of 6 individuals, and then we have 2 assistants, so a team of 8 total. And just making sure that we grow at the right pace, add the right team members, and have a lot of fun along the way doing it.
Man, that's awesome. So you mentioned obviously you're still looking at deals, you're still looking to expand, and continue to do that over the next few years. This is something that you and I probably hear all the time on the news, and see articles all the time. But right now, if you're listening, we're recording this in July 2023. Interest rates went from super low last several years to 8 to 9% now. Do you think now is still a good time to buy multifamily?
That is a great question. And I think it depends. For us, yes, but it needs to be the right asset in the right location with the right debt and with the right team. So you had mentioned, if you go with a bank loan or a bridge lender, you're likely paying 8 to 9%, maybe even higher right now. But with agency loans, so it's a government-backed program, Freddie Mac and Fannie Mae, they give some really advantageous loans for multifamily, and we're able to secure financing at about 5.5% right now for 7 to 10 year periods. And if you take a look at the historical interest rates, 5.5% is actually a pretty dang good rate. I know we've gotten used to, the twos and threes, but that's not the historical norm. So we love that. Inflation obviously is eating away people's purchasing power, and multifamily really battles that, because as we see inflation in the market, rents tend to go up with inflation as well. So inflation actually helps multifamily. Sure, it can negatively impact you on the expense side, but a lot of times you can make up for it and some on the rent side. So that's a huge plus. The tax advantages are still really good. This year we have 80% bonus depreciation. And I won't get too in depth there, but that means that you're seeing a bigger depreciation loss on paper year one of ownership when you invest into these multifamily opportunities. And that can help, offset any capital gains or investment income that you have coming in elsewhere, or you can, carry it forward if you don't use it all. Yeah. So I love that. The other aspect I love is we're really becoming a renter nation. Right now, I think it's about 33% of our nation is renters, and that's expected to rise to about 35, 36% over the next few years. And that's a huge indicator of the amount of demand that's coming down the pipeline for multifamily. So I love that there's demand there, plus multifamily weathers economic downturns very, very well, especially B and C class properties, which we're heavily involved with.
Yeah, exactly. Because people have to live somewhere, right? And usually those A class, if you're kind of in a bind, you might move down to a B class, or B class moves down to a C class, but people still have to live somewhere. The other thing, and you didn't mention this, Mike, but the Fannie Mae did a report a few years ago about how we're already, this was in 2020, I guess, or 2019, but there's already a housing shortage, and that's only going to get worse over the next now 6.5, 7 years. This decade, it's going to get worse before it gets better. So, I mean, you hit it, spot on. I think why now. It can be a great time to buy if you do it right. And I think that apartments and multifamily property only going to be better investments, at least for the foreseeable future, just for, kind of a storm of so many different things all throughout this decade. So love that answer. Mike, what is the best way for the audience to reach out to you?
Yeah, best way would just be to jump on our website. It's granitetowersequitygroup.com. Again, granitetowersequitygroup.com. And you can fill out our contact us page. That'll get you into our database. So you'll see any future deal flow. You'll see our newsletters. You can really educate yourself as well. And then mention passive investment tracker, and we can send you off our free passive investment tracker. And then on our website, we also have a free ebook on passive investing too.
Yeah, that's awesome. And so that website, and I'll put these in the show notes, granitetowersequitygroup.com. And the free ebook is granitetowersequitygroup.com/free-e-book. Again, I'm going to put all that in the show notes. And then as far as that free passive investing tracker that you have, is that on the website as well, or do they just need to reach out to you and then request it separately?
It is not. So just fill out the contact us page on our website and mention the passive investment tracker, and we'll make sure to email that over to you ASAP.
Awesome. Man, Mike, I really appreciate talking to you. Again, I mentioned this even before the call, mentioned this a little bit ago in the interview, but you're one of the first people I met in that's doing multifamily syndication. I believe it was my second deal I invested in was with you and Dan and your team and some others. And I've seen some of the deal. It is really cool to tour some of these properties and then to see what you guys have done to it from an outside perspective. Because like I said, I've been to a couple of these and I know kind of what you bought, and I've seen what they are now and all that. So I love that personally. Just I'm so passionate about real estate, and I think it's really neat to see that. I'm really really, truly, thank you so much for being here and spending 45 minutes or so with me. It's been an honor talking to you, Mike.
You bet. Well, thank you so much for having me on, Charlie. I really appreciate it. And let me know if I can help in any way.
Sounds good. Thanks, Mike. Thank you for listening to today's show, brought to you by H&K Investment Group, your home for passive investing. If you want to learn more about how you can invest with us, please check out our website at hkigllc.com. Don't forget to like this episode and subscribe to our podcast. Please leave us a review to let us know how we are doing. Feel free to connect with me directly on LinkedIn or Facebook. As always, I'm your host, Charlie Hardage. Catch you next time.